All right, it looks like we are at time, so let's go ahead and get started with today's webcast. My name is Chinajun and I'm with NACB and the Consultants Training Institute. Before we continue with the November 2025 edition of Around the Valuation World National, I want to go over a few housekeeping items. There's our disclaimer. First, to obtain CB credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have an ABW international subscription with us, you'll see the certificate within 7 to 10 business days after today's webcast. In addition, if you have any questions today, if you have any questions for the presenter, please use the Q&A submission box through Zoom. If you have any technical questions or questions about NACBA, please feel free to reach out to me through the chat feature, and I'll be happy to assist you with that. With Around the Valuation World and Around the Valuation World International, we try to cover all the hot topics in the industry that's happening. With the 1 hour that we have during this time, we don't have enough time to cover all the information that's being released. So there are some links to some additional resources if you are interested in staying up to date in the industry. This page shows our editors. We have Wolfgang Neese, Andrew Newman, Pratik Shah, with our advisor Brian Jones. Unfortunately, Wolfgang is unable to join us today. As usual, we'll have the GACVA news items that we'll go over, followed by Cagdas Gurpinar, who will be discussing IPEV guidelines in a nutshell, best practices portfolio evaluations. And just really quick, we just want to let you know that for the GACVA news items, we do have a virtual summit coming up next month. So if you are due for recertification, that's a great opportunity to obtain those CP hours that you'll need by the end of the year. So that will be December 3rd and 4th and 5th. And then with the Around the Valuation World, we also added the Around the Valuation World in depth, where we go into deeper depth with some of the other topics in the industry as well. So in December 15th, we have Who Owns the Customers, Valuing Interest in Service Firms. January 12th, we have Growing When No One Else Is, and February 9th, Getting Personal with Personal Goodwill. So if you are interested in any of those topics and interested in entertaining CP for that, please scan the QR code or visit the nacb.com/abwn webcast or website, excuse me. And then we also have our primer as well. So AI is a big topic in the industry right now. We are trying to stay up to date on that. So we are hosting a bunch of webinars. There is an upcoming AI for Valuation Forensics primer webinar that's coming up as well. So if you're interested in that, highly recommend that you visit that to get more information on that and register for that. And with that, let's turn over to Pratik Shah, who will get us started with today's webcast.
Thank you, Chanda, and good morning, everyone. So, have privilege to introduce Cagdas. So, he's a seasoned valuation professional with over 11 years of experience, including 9 years with Deloitte Turkey and 2 years in Deloitte US. Throughout his career, he has led numerous business and intellectual property valuation engagements, supporting clients in financial reporting, merger acquisitions, and decision-making strategic projects. He's an expert in IFRS 3, ASC 805, and ASC 350, bringing deep technical knowledge of compliance, requirements, and valuation best practices. He holds a Bachelor of Science in Accounting from Gazi University and Master of Science in Accounting from Lehman College. Following his tenure at Deloitte, he transitioned to freelance valuation consulting, where he provides independent, high-quality valuation services to businesses, investors, legal entities, and startups. His global experience and analytical expertise makes him a trusted advisor in complex valuation matters. With here, I'll be more than happy to get the presentation started on IPEV guidelines in a nutshell, best practices for portfolio valuation. So over to you. And if there are any questions in between, please do put on chat. Cagdas can take it up in between, or we can take it at the end of the session. Over to you.
Thank you, Pratik, and thanks everyone. Let me share my screen. All right. So good afternoon, everyone, or good morning, and welcome to IPEV Guidelines in a Nutshell, Best Practices for Portfolio Valuations webinar. My name is Cagdas Gurpinar, and over the next hour, we'll unpack the key principles behind the International Private Equity and Venture Capital Valuation Guidelines, commonly known as the IPEV guidelines. These guidelines are the cornerstone reference for valuation professionals, fund managers, auditors, and investors involved in private capital markets. Today's presentation is designed to help the audience firstly understand the purpose and evolution of the IPV guidelines. Secondly, recognize how they align with the international accounting frameworks like IFRS and the US GAAP. And thirdly, learn practical insights into applying fair value principles consistently across portfolio investments. I will also highlight the most recent revision, the December 2022 update, and what it means for private equity and venture capital valuation practices going forward. The IPV guidelines were first issued in 2005, and since then they've become the global benchmark for valuing unlisted investments. They are not a set of mandatory rules, but rather a collection of best practice recommendations that aim to promote transparency, consistency, and comparability in valuations. The IPEV guidelines are issued by the IPEV board, which is composed of representatives from leading global private equity industry associations and professional bodies. The guidelines are updated periodically to reflect evolving market conditions, changes in financial reporting standards, and lessons learned from, of course, practical application. The 2022 update, for instance, placed stronger emphasis on market participant assumptions, calibration, and the fair value hierarchy. Nowadays, private market valuations play a big role in how funds look, what investors hear, and even how capital gets allocated. So at the end of the day, what really matters is being consistent and credible. Otherwise, the whole system starts to wobble. The IPV guidelines serve as a bridge between valuation theory and practical implementation. They help ensure that valuations reflect fair value as defined under IFRS 13 and ASC 820. Reports are transparent, auditable, and defensible. And lastly, investors and auditors share a common language when assessing portfolio valuations. At the core of the guidelines is the idea of fair value. Basically, the price you would expect to get if you sold the asset in a normal, non-distressed deal with real market participants on that specific date. When we follow the IPV framework, we are making sure of our fair value estimates line up with both IFRS and US GAAP. So whether someone's looking at the numbers in New York, London, or anywhere else, they're speaking the same valuation language, and the consistency is huge. The standardization is especially important given the growth of cross-border investments and the increasing scrutiny of valuation practices by regulators and investors. So to summarize this introduction, the IPEV guidelines provide a consistent principles-based approach to fair value measurement. They are globally recognized and aligned with accounting standards. The 2022 revision refines how we interpret market participant assumptions and calibrate valuation techniques. With that foundation, let's now move into our next segment where we'll look at the structure and core principles of the IPEV framework. Now that we've covered the purpose and the broader context of the IPEV guidelines, let's shift into the heart of the framework, which is the concept of fair value and the core valuation principles that form the foundation of the guidelines. This segment is essential because it covers how we interpret valuation evidence, which assumptions we are allowed to use, what perspective we are required to apply, and why certain techniques are acceptable while others are not. What I want to do in this section is to unpack not just what fair value is, but also what it is not, and explain why these distinctions matter so much for private capital valuations. The starting point and truly the foundation is the definition of fair value. And the fair value is defined as the price that will be received to sell an asset in an orderly transaction between market participants at the measurement date. This definition is completely aligned with IFRS 13 and US GAAP ASC 820. IPEV didn't invent a new concept of value. Instead, it provides detailed guidance for how to apply the global fair value standard specifically to private equity and venture capital investments. Fair value is fundamentally a market-based measure, not an investor-specific one. And it represents the view from the marketplace, not from the GP, the LP, or the management team. There are four main assumptions of fair value. Number one is the orderly transaction. When the standard refers to an orderly transaction, this doesn't mean a perfect market environment. What it means is a transaction that is neither forced nor distressed. There is sufficient time for marketing the asset. There is no compulsion to sell at fire sale conditions. Both buyer and seller are assumed to be exercising reasonable business judgment. Number two is market participants. The fair value assumes hypothetical but realistic market participants. These are buyers and sellers who are independent, reasonably informed, financially capable, and motivated, but not overly eager or distressed. In other words, the price reflects what typical knowledgeable participants in the private markets would agree upon, not insiders with special information or investors with unique strategic motives. And number three is the measurement date, which is also another important factor, assumption. The fair value is tied to a very specific point in time. That means no hindsight, no adjustment based on events that happened afterwards, unless the information was already known or knowable on that date. But this principle prevents valuation from being influenced by information that didn't exist when the valuation was supposed to be measured. And fourth assumption is principal and most advantageous market. But finally, valuations assume the transaction occurs in the principal market, meaning the market where the investment is normally sold. If such a market doesn't truly exist, we shift to the market that's most advantageous. This assumption basically helps us keep the hypothetical transaction on this same playing field every time. It keeps things consistent, so we are all imagining the same kind of deal. So what fair value is not? It's It's equally important to clarify what fair value is not, because this is where misconceptions frequently arise. So fair value is not the amount realized in a forced or distressed sale, is not a value adjusted for investors specific factors like fund size or exit timing or tax considerations, and not a strategic value that a particular buyer might be willing to pay for synergies. It's also not a value artificially depressed by excessive liquidity discounts beyond what market participants already embed in pricing. Fair value always um, comes from clean um, market-based point of view. You can think of it as an arm's length lens. No special investor motives, no internal constraints, no made-up discounts, just what the market would reasonably argue on. The guidelines place a very strong emphasis on consistency. What does consistency mean in practice? It means that if you valued a company using a multiples-based market approach last quarter and nothing material has changed in the company's business model, capital structure, or risk profile, then you do not switch to a DCF or another technique without a valid reason. So consistency builds reliability and allows investors and auditors to compare valuations over time. It also disciplines the valuation professional. If results change dramatically, the question becomes why. One of the most important and sometimes misunderstood requirements is the need to adopt the market participant perspective. The valuation professional must step out of the shoes of the GP or the LP and step into the shoes of a typical buyer in the marketplace. This has real consequences. It means we cannot use internal hurdle rates. We cannot apply investor-specific premiums or discounts, and we cannot lean on our own internal forecast as the only reason for the value. That's not enough on its own. Instead, we ask, what would a well-informed, rational buyer pay today, given what is observable in the market? In addition to the independent review, the guidelines also emphasize governance, not as an administrative detail, but as a core element of good valuation practice. So IPEV recommends that each firm maintain a written valuation policy that clearly defines the methodologies permitted, how calibration will be applied, how frequently valuations are updated, and what internal controls exist and who reviews and approves valuations. A strong governance framework usually includes a valuation committee, uh, periodic independent third-party reviews, and consistent backtesting to compare previous fair values with actual exit values. Additionally, documentation is critical. Auditors and regulators want to see transparent and traceable logic, not just the output values. And documentation should include sources of market data, rationale behind the key assumptions, explanations for method selection, and clear evidence of calibration and so on. So briefly, without proper documentation, even a correct conclusion can look like it doesn't have anything behind it. So the next topic is valuation approaches. The guidelines valuation organize the valuation techniques into the same three major categories used in IFRS and IFRS 13 and ASC 820. Market approach, income approach, and replacement cost or net assets approach. So let's take a closer look at each briefly. Market approach relies on observable market evidence, and evidence can come from public comparables, comparable transactions, or the quoted price of identical or similar instruments. The most common technique here is multiples-based valuation. Examples include EV EBITDA, EV revenue, price earnings, or sector-specific metrics like subscribers or ARR multiples. When you first invest, you need to calibrate your market multiples. To basically take the price you pay and line it up with what market is showing for similar companies. That helps you figure out where your company actually sits relative to the comps. Transaction-based evidence such as recent financing round may also be relevant, but as we'll discuss later, it must be evaluated carefully to ensure it reflects market conditions. The market approach would be considered as the best approach, especially when there are good comparable public companies, performance metrics are meaningful, or recent transactions exist that reflect orderly market behavior. Second approach is the income approach. It centers on the future economic benefits of the investment. The most common technique is the discounted cash flows or DCF. It involves projecting expected future cash flows, usually free cash flow to the firm or equity, and discounting them at a rate that reflects the risk of achieving those cash flows. This approach is especially suitable for debt instruments where coupon payments are known, preferred securities with structured payouts, infrastructure assets with contract revenues, and mature companies with more predictable financial profiles. The challenge is that early stage venture capital companies typically have less predictable cash flow, so the DCF plays a relatively smaller role there. And the third one is the net assets or cost approach. It values a company based on the fair value of its underlying assets minus its liabilities. And it's typically relevant when the business is in very early stages. Its economic value is tied to assets rather than earnings, or the entity operates more as a holding company. In VC, this might apply to pre-revenue biotechnology companies or R&D heavy businesses, or companies whose primary value comes from IP or development assets. So here's an important point. The guidelines don't treat any one valuation method as the automatic go-to. There's no single technique that's always the best valuation. The valuation is not a plug and play formula. It's a framework rather, and relies heavily on professional judgment to make the right calls. But choosing the right approach depends on the stage of the company, the structure of the investment, the availability of reliable market data, calibration to the original transaction price, and market participant expectations. In many cases, the best practice is to use multiple approaches to triangulate fair value. For example, you might rely primarily on market approach, but cross-check the results using DCF or vice versa. Another example for early stage venture companies, we might use a recent financing round as a starting point, but we should validate it using calibrated market multiples or scenario-based models. The goal here is to reach a conclusion that is supportable, grounded in observable evidence, and reflective of market participant reasoning. To wrap up this section, fair value is a market-based, not investor-specific measure aligned with IFRS and US GAAP. Consistency, market participant perspective, and strong governance are not optional. They are core pillars of defensible valuations. The market, income, and cost approaches form the practical toolkit for valuation professionals. In our next segment, we'll build on this foundation and dive into some practical applications. Let's now turn to 2022 revision of the IPEV guidelines, the most comprehensive update since 2018. These guidelines supersede the previous 2018 version and are effective for reporting periods beginning on January 1, 2023. The 2022 updates were shaped by broad industry feedback, regulatory developments, and especially by lessons learned during periods of intense market disruption, including the COVID-related volatility of 2020 and the sharp repricing of risk in 2022. One of the big reasons for updating the guidelines was to make fair value measurement clearer, more practical, and more consistent for today's private markets. The landscape has changed a lot. Higher interest rates, bigger gaps in how different sectors perform, slower exits, and more down rounds. So the guidelines needed to catch up and address what's actually happening out there. Another objective was to reinforce how the valuation process should reflect market participant perspectives, especially in times when observable market inputs are more volatile. That's why the 2022 update puts a lot more emphasis on calibration, making proper market adjustments, and continuously reassessing fair value instead of just leaning on old numbers. So one of the most significant clarifications in the 2022 guidelines relates to the price of a recent investment, or PORI. Historically, many practitioners fell into a common shortcut. We just invested at this price, therefore that must be the fair value. But the guidelines emphasize that the reasoning is not compliant with a fair value measurement framework. PORI may be useful data point, but it's not automatically fair value. The 2022 guidelines reaffirm that fair value must be reassessed at each measurement date. Even if the transaction occurred very recently, say 30 or 60 days ago, the relevant question is, would a market participant transact at the same terms today, given current conditions and company performance? Market sentiment, public comparables, interest rates, risk premiums, or the company's execution since the deal date may have shifted. So PORI is merely an input, not an outcome. This really matters today, especially when rounds come with complex structures. The bridge notes get priced fast just to get a deal done, or strategic motives are driving the transaction. The guidelines remind us not assume a deal price automatically equals fair value. We still need to dig in and analyze. So this is where calibration comes in. So calibration basically means checking that your valuation approach, whether you are using market multiples or DCF or something else, can actually recreate the deal price using the market inputs that existed at the time of transaction. It's a way to make sure the methods line up with reality at, at entry. The principle is simple. If the transaction price was deemed to reflect fair value at entry, your valuation techniques should be able to explain why. This creates an analytical anchor. Once that calibration is established, you carry the technique forward by updating only the inputs at subsequent measurement dates. Basically, calibration turns the entry price into a benchmark. How did the company perform relative to expectations? How did market multiples move? Did discount rates change? Did risk factors increase or decrease? Let me give you an example regarding how calibration works. Suppose a company was acquired at 10x EBITDA, while comparable public companies were trading at 12x at that time. That 2x spread represents market-based adjustment, perhaps reflecting liquidity risk, smaller scale, customer concentration, and so on, numerous other reasons. When we calibrate, we don't simply ignore that spread. We ask, what characteristics explain the difference between private company and the public comparables at the transaction date? Now let's move forward to the measurement date. If comparables have expanded to 14x, it doesn't automatically mean the calibrated multiple should also jump proportionally. The valuation professional has to reconsider whether the original risk factors still apply. Has customer concentration improved? Or on the flip side, have things gotten tougher in the sector overall? In some cases, the spread may narrow if execution has improved or if the company is approaching profitability. In other cases, the spread may widen, especially during periods of market stress or if company performance has lagged expectations. Calibration is not some mechanical checkbox, or it's a structured, evidence-driven way to connect what the deal looked like on day one with what the market looks like today. So calibration matters because it keeps our valuation work grounded in actual market evidence, not just what a spreadsheet spits out. It forces us to compare how we viewed risk at the time of the investment with how those risks have changed, evolved since then. And it builds a clean audit trail showing that movements in fair value come from real, observable market shifts, not from anyone being overly optimistic or pessimistic. And calibration also makes sure our valuations reflect what real market participants would think, not any investor's specific motives or strategic reasons that might have shaped the deal price. And at the end of the day, calibration strengthens things like discipline via linking valuation inputs to documented market evidence, consistency by reducing arbitrary shifts in methodologies over time, and transparency by making the rationale behind fair value adjustments explicit and defensible. This is why the 2022 guidelines place such strong emphasis on calibration. In today's market environment where conditions can quickly shift, calibrated valuations provide reliable and objective basis for financial reporting. Next, let's look at the principle of known or knowable information, an area that received clear emphasis in the 2022 update and often raises practical questions. In fair value measurement, the measurement date serves as a hard cutoff. Fair value must reflect the information that was known or reasonably knowable as of the exact date. In other words, fair value should always reflect the facts and expectations that existed at that point in time, along with anything a typical market participant could have reasonably learned through normal inquiry or keeping an eye on the industry or doing standard due diligence. And the guidelines are very clear about this. You are not expected to dig up extraordinary information or have insider level insight. No one is supposed to know things that would only come from material, non-public information. The real question is simply, what would a well-informed market participant have reasonably understood about the company and the market on the measurement date? This includes publicly observable market movements, widely circulated industry developments, that specific company's performance up to date, and any specific information that management had already communicated or would routinely share with potential investors. On the other hand, information that emerges after the measurement date, a customer loss maybe, or a new contract win, or regulatory announcement, that cannot retroactively change what fair value should have been at that earlier date, unless it was already knowable at that time. This principle protects us from slipping into hindsight, and that's key for consistency and for standing up to an audit. Fair value is a snapshot of what things look like then at that time, not a rewind and judge moment. Now, what happens if a transaction takes place shortly after the measurement date? This is an area where practitioners sometimes fall into a hindsight trap. The 2022 guidelines clarify that post-measurement events, including deals, rounds of financing, or acquisition offers, may be used as evidence of fair value only if they reflect conditions that existed at the measurement date. So the relevant question becomes, does this later transaction provide insight into what market participant already believed or could have known on the measurement date? If yes, the transaction can be a highly relevant data point. If no, if new information emerged afterward that influenced the price, then it should not be used as a direct anchor. Even when the transaction is relevant, the valuation professional must make adjustments for several factors, including execution risk, shifts in market sentiment, or change in deal terms, like repricing or revised covenants or different structure, that sort of changes. Finally, the big takeaway is this. Deals that happen after the measurement date can help inform fair value, but only if we look at them in light of what was actually knowable at that time. We don't just plug them in automatically. We still have to evaluate them carefully. The next area expands on valuation in distressed or dislocated markets, a topic that became important during the COVID-19 shock, and again during the market repricing of 2022. The key message from 2022 amendments is that the fair value premise doesn't change just because markets are turbulent. Even in highly volatile periods, fair value continues to represent the price that a market participant would pay in an orderly transaction under current market conditions, not conditions from 6 months ago, or not hypothetical stable markets. This is an important point. Fair value still reflects the reality of the moment. If markets have pulled back, risk premiums widened, or liquidity conditions worsened, those facts must be incorporated into the valuation. However, and here is the nuance, the guidelines warn against interpreting every low price data point as representative of fair value. The challenge in distressed environments is distinguishing between genuine price discovery reflecting new economic reality and forced or distressed transactions that do not represent orderly market behavior. So how do we determine whether a transaction is distressed? The guidelines provide several indicators that a transaction is not orderly and should not be used as a fair value evidence. A transaction may be considered distressed if it was legally required, the seller had insufficient time to market the asset, there was financial duress, for example, in a bankruptcy or similar situation, or only a very limited set of potential buyers was approached. So these are the situations related to distress sale. In such cases, the transaction price reflects urgency and pressure, not the normal functioning of the market. It may undervalue the asset based solely on the seller's situation, not the underlying economics of the company. Therefore, when distress indicators are present, the valuation professional must avoid anchoring to that transaction and instead rely on other valuation techniques. For instance, calibrated market multiples or DCF with updated risk inputs or scenario analyses to better reflect market participant assumptions. This distinction became especially important in 2022 era when some transactions happened at opportunistic prices simply because liquidity was scarce. So briefly, valuation professionals must remain grounded in market participant reasoning, not panic pricing. Just because a transaction is observable doesn't mean it is automatically relevant. We have to look at the context behind it. And even when markets are dislocated, fair value is still based on the orderly transaction. The real challenge is separating the signal pricing from the noise of distressed or forced sales. This guidance helps keep valuations from overreacting to one-off crisis-type deals and makes sure fair value reflects meaningful economic evidence, not short-term fear. Another new and significant addition in the 2022 guidelines or amendments is the section of environmental, social, and governance ESG factors. For the first time, IPEV explicitly states that ESG factors should be considered in valuation whenever they would influence how a typical market participant evaluates the company's risk profile. This doesn't mean that ESG automatically increases or decreases value. Rather, ESG factors are treated the same as any other factor. If it is relevant and if it's known or knowable at the measurement date, then it belongs in the valuation analysis. For example, a company with strong renewable energy adoption may benefit from lower long-term operating costs or eligibility for incentives. Contrarily, a company with weak governance, controls, or exposure to regulatory penalties may face heightened risk, which could influence discount rates or expected cash flows. The key is to evaluate ESG through the lens of market participant assumptions, not through policy preferences or ethical viewpoints. The guidelines outline two broad ESG ways ESG can influence fair value. One, quantitative effects, in other words, measurable financial impacts. For example, cost savings from energy efficiency programs, incremental capital expenditures tied to environmental compliance, revenue increases from sustainable product lines, excuse me, or even changes in long-term margin expectations if ESG drives consumer preferences. These impacts naturally flow into cash flow projections or terminal values. Secondly, there are qualitative effects, which reflect the impacts related to the perception of risk or company's long-term outlook. These are less directly measurable, but still highly relevant to valuation. They include reputational effects, governance quality, management credibility on sustainability goals, and the likelihood of attracting certain categories of investors or strategic buyers. These kind of qualitative factors can affect things like discount rates, returns, or how attractive the company looks compared to its peers. But the core principle stays the same. If an ESG factor was known or knowable at the measurement date, and it would matter to a market participant, then it needs to be reflected in the fair value analysis. That could be through numbers or simply through a well-supported narrative. Let's begin with one of the most practically significant areas of the 2022 updates, valuing early stage companies and complex capital structures, essentially the venture capital world. Early stage valuation is challenging a bit because traditional valuation tools often don't apply cleanly. At seed or early stage rounds, companies may have limited operating history, negative or highly volatile cash flows, rapidly evolving business models, uncertain product market fit, or large execution risks that are difficult to quantify. The guidelines emphasize that relying on a single headline valuation, usually the fully diluted post-money valuation from the most recent financing round, often oversimplifies the economic reality. Why? Because that round represents the price paid for a specific security class, not for the entire company. That class typically has certain rights, preferences, conversion features, uh, participation mechanics, anti-dilution protections, or seniority terms. These can meaningfully influence how value is split across the cap table. The 2022 update underscores that these terms often create different economic outcomes for each class of shares. For example, preferred shares may receive liquidation preferences that guarantee them downside protection, or common shares may participate only after senior classes are paid out, or convertible notes may convert at discounts or caps that create asymmetric payoff structures, and so on. If you simply take the headline post-money valuation and apply it across all shares, we risk overvaluing junior share classes, especially common stock held by founders and employees. So the guidelines encourage practitioners to reflect the actual economic substance of the capital structure, not just the headline valuation. To address these complexities, the 2022 guidelines highlight several advanced methods that better capture the real economic rights of each share classes. First bucket of these advanced models is scenario-based models, or PWERM. The probability weighted average expected return method. It explicitly models discrete exit scenarios. You develop a set of potential outcomes, for example, an IPO, a strategic sale, or down round recap, or basically a failure, maybe. And then assign probabilities to each scenario. For each scenario, you allocate proceeds according to the capital structure waterfall. PWERM is particularly useful when management or investors have specific expectations about milestones, or there are meaningful information asymmetry, or the company is approaching a liquidity event. Another useful model is the option pricing method, OPM. OPM models the capital structure like a series of call options. Each share class receives value only if the company's total equity value exceeds the breakpoints implied by the preferences and seniority layers. OPM assumes a continuous distribution rather than discrete scenarios. I'm sorry. So OPM provides a mathematically rigorous way to allocate value across classes while respecting seniority and priority rules. And there's a third bucket, hybrid combined models, or it's called OPM backsolve models. This is particularly relevant when the recent transaction is considered orderly and representative of fair value. If you fail to apply these methods appropriately, we risk materially misstating value, usually by overstating the value of common stock or understating the economic advantage enjoyed by senior preferred holders. The key practical takeaway here is that the 2022 guidelines push the industry toward more granular, data-driven, economically consistent techniques when valuing early-stage companies. Investor auditors and boards are all looking for more rigor these days. And that rigor comes from really understanding the capital structure, modeling the true economics of each share class. In the end, this push leads to valuations that are clearer and more defensible and more fair, which is especially important in the venture world. There's also one area I would like to touch on, and blockage factors and contractual restrictions. A blockage factor refers to an adjustment to reflect the size of the position held. For example, discounting value because an investor holds a very large block of shares that might be hard to sell quickly. The guidelines reiterate that blockage discounts must not be applied. Why? Because the size of the investor's position is an attributable of the holder, not of the asset itself. Fair value is based on the assumptions of an orderly transaction for the asset as a whole, not on how long it would take the current holder to liquidate their positions. This aligns with the updated US GAAP guidance under ASC 820 and reinforces the principle that fair value is market-based, not entity-specific. However, this is the nuance. Certainly, legally enforceable restrictions can be considered. If a restriction is part of the security itself and would apply to any market participant, for example, governmental restrictions on transfer or regulatory holdings period, or legal prohibitions embedded in the security, then it affects the characteristics of the asset and therefore can be reflected in fair value. Contrarily, contractual sale restrictions that apply only to the current holder, such as underwriter lockups, shareholder agreements, or internal fund policies, should not result in a discount. They are viewed as a holder-specific constraints. Okay, next area is finance. Finally, we have, I think, a few minutes. Finally, the 2022 guidelines introduce a more detailed guidance for valuing debt instruments. In the past, a lot of people just defaulted to valuing debt at par or face value or whatever it cost originally, but the guidelines make it clear none of those automatically equal fair value. It basically says debt should be valued the same way any market participant would assess a fixed income instrument, basically using a yield-based or discounted cash flow approach. In doing this, the practitioner should consider the borrower's current credit quality, changes in default risk or covenant headroom, contractual coupon rates versus prevailing market yields, and market liquidity conditions. And basically, I can jump to I still have some slides, but I think
Yeah, I think we're at time.
yes, we're out of time.
Yeah. So Cagdas, thank you so much. I know there's so much great information and you have several slides, but we didn't get to it in time.
Thank you. Sure.
But
And I'm happy to receive any questions if they email. and I would be happy to answer, and I would be happy to connect any colleagues here in audience via LinkedIn. And thank you so much, Chanda and Pratik and Andrew.
Hey, Cagdas, thank you so much for joining us today. I know we're going to have you on for an extended webinar. I think it's in March, actually. March 16th, I believe, is the date. So we
Right.
look forward to working with you again, and thank you for joining us today. And also thank you for all of our guests for joining us. Just a quick little note, our next AVW International Webcast will be December 8th, 2025. It is a little earlier than normal, only because of the holidays coming up. So for those who are celebrating, I wish you all a great Thanksgiving this week. And I would look forward to seeing you all next week, or next month, excuse me. All right. Have a great day.
Thank you.